In lieu of November's monthly webinar, we decided to provide this short tutorial on employer health FSA forfeitures. This short topic came out of some common questions we received from some of our FSA clients regarding how to limit the risk of loss that there is regarding FSA forfeitures. And so just to get started, this risk of loss and FSA forfeitures arises from what's known as the Health FSA Annualization rule. And what that means is the full amount of an employee's health FSA election must be available for reimbursement on the first day of the plan year. So if I make a $2,500 election for the FSA for the 2018 plan year, that entire $2,500 should be available to me on January 1 of the 2018 plan year for reimbursement. If I have a claim for $2,500 on January 1, I should get reimbursed for that full amount. However, as most of you know, employees contribute to the Health FSA pro rata throughout the plan year. So my $2,500 election is going to get divided up by the number of pay periods there are, and that's the schedule for which I will be contributing to the Health FSA with my salary reductions. So this annualization rule combined with the contribution schedule creates a risk that the plan will reimburse the employee for a greater sum than the employee contributes to the plan. So if I have a large medical expense at the beginning of the year and I get reimbursed the full amount of my election at the beginning of the year, but I have only contributed a small amount to the plan, and I terminate employment or for some other reason stop participating in the plan, then the employer has in some sense experienced a loss because they have reimbursed me for more than I have contributed to the plan. So at times we have some employers ask us about different methods for sort of limiting this risk of loss, and I wanted to talk about some of those, some approved methods and some impermissible methods as well. First, let's talk about some permissible ways to minimize the risk of loss. The first thing that the employer can do is lower the maximum reimbursement amount offered by the plan. So in 2018, the IRS has set an FSA maximum of $2,650. It is possible, however, for the employer to set a lower amount. For example, $1,500. The employer could set the maximum there and only allow that amount to be reimbursed in the Health FSA. Obviously, one issue with that is that lowers the amount of dollars running through the plan, and that in turn lowers the amount of tax savings for both the employee and the employer. Another method employers can use is to extend the eligibility waiting period. This happened more often pre-ACA, before the rule, the 90-day waiting period rule for medical insurance. For example, the Health FSA waiting period may have been set at 6 months or a year. And this sort of just filtered out for some employers with high turnover, some employees that may not have stayed employed for more than a couple months. Again, since the ACA and the 90-day waiting period rule for health insurance, now employers tend to simply just match up the Health FSA eligibility with the medical insurance eligibility. Employers could also limit eligibility to those covered by the medical plan. This is not entirely not very common, but it is possible for the employer to do to sort of weed out some other potential participants that may be turning over more often than others. The employer could also limit the category of eligible medical expenses. For example, they could exclude some types of expenses that may be high claims at the beginning of the year. This is not very participant friendly, and it can be difficult to administer depending on whether you have a third-party administrator helping you or not. So it's not really a plan design that employers use very often. Another potential option, which really only helps with cash flow and doesn't help with the risk of loss, is requiring advanced premium payments or advanced contributions for the health FSA. So it is possible, although contributions are normally made monthly on a pro rata basis, it is possible for the employer to require advanced premium payments. For example, the employer could require employees to make 6 months worth of contributions in the beginning of the year. And this really helps with cash flow because the employer now has 6 months of contributions that they can use to reimburse expenses incurred very early in the plan year. However, it doesn't help with the risk of loss because any unused premiums need to be returned to the participant. So if the employer requires 6 months contribution at the beginning of the year and the employee only ends up working 1 month and then terminating, the employer is required to return 5 months worth of the contributions to the employee. So again, it doesn't really help with the risk of loss. It's not really something commonly done among employers. Last potential method the employer could use is to narrow the change of election rules to limit the number of qualifying events that would allow a change to the health FSA. Again, this isn't really a very participant-friendly design. It also really doesn't help with termination, which is really the main qualifying event that causes the risk of loss. And because of that, it's just not often used as well. So despite the fact that we have a number of permissible ways to minimize the risk of loss, for practical reasons, really, that they're not used very often. Lastly, I want to talk about some clearly impermissible ways to minimize the risk of loss. The first approach is limiting reimbursement to the amount of the contribution. So if I have only contributed $200 during the plan year, then I can only be reimbursed for that $200 that I have contributed. This is clearly a direct violation of the annualization rule on its face, so it really, just by virtue of the rule itself, is not a permissible way to minimize the risk of loss. The second thing, and probably the most commonly asked method of us as to whether it's permissible or not, is requiring repayment of excessive reimbursements. So if an employee terminates mid-year and they have been reimbursed for more expenses than they have contributed, the employer might want to require them to make up the contributions, at least returning as much as has been reimbursed to them. This is not permissible. It's never permitted, even if the employee voluntarily is willing to pay to make up those excess reimbursements. It's not even permissible in that situation as well if the employee is willing to do it. So again, clearly impermissible method for minimizing the risk of loss. Finally, it's also impermissible to require departing participants to continue through the year end. So if someone terminates mid-year, it is impermissible to require them to continue to pay contributions even if you are willing to allow them to receive reimbursements throughout the year as well after they terminate. So these are a couple of clearly impermissible ways to minimize the risk of health FSA loss. But we wanted to provide these rules and these potential methods for minimizing the risk of loss, but more than that, we also wanted to impart the idea that the risk of loss really shouldn't be a main decision driver for the employer when deciding whether to offer a health FSA. Employer losses certainly can happen on an individual participant basis, but those employer losses are often balanced out by employer gains when a participant underspends their FSA and terminates, or underspends the FSA throughout the plan at the end of the plan year and forfeits those funds. So those experience losses and experience gains for the employer tend to balance out over the course of time of offering the health FSA. In addition to this balance, there's also significant tax savings with offering the plan. The tax savings almost always outweigh the potential risk of loss. The benefit of the tax savings is certainly more important to the employer than offering than the potential risk of loss. So it is almost always in the employer's best interest to offer the health FSA, and minimizing the risk of loss really shouldn't be a main consideration of the employer. Again, I hope this tutorial was helpful to you. This is in lieu of the November webinar. We will be back in December to continue our webinar series. And in the meantime, I hope everybody has a good Thanksgiving and a good lead up to the holiday season.